Dave,
Hey, Zach.
what's going on?
Here we are again. We're going to talk about some mortgage stuff.
Mortgage stuff. We do mortgages?
Yes.
But today, what we're really talking about is what?
If something bad's going to happen, what do we do next to get back on the horse? So today we're talking about major derogatory credit events and how to get back on the horse and buy a home after that happens.
That's great. I think that we all know people in our life that could benefit from learning a little bit about how to prepare if you are facing some tough stuff or what to do if you have gone through some tough stuff. So we're going to try to expose some myths for the audience today.
Yeah, so if you're a professional and you happen to be advising people on, for example, if you're an attorney and you're going to advise somebody on bankruptcy, you can also provide some proactive measures on motivating people for how they're going to deal with what comes next, buying a house later. Also, if you've been through these events or if you're about to go through these events, rather than just wait until everything blows up and then kind of sit there and kind of be depressed and wait a couple of years go by, better to just start planning the next move as soon as possible so that it can go as quickly as possible. And that's what today is, to help you make this tough period last as short a time as possible.
So what are some of those items that people might be facing? We've got bankruptcy, foreclosure, what else?
So sometimes you have to choose a deed in lieu of foreclosure, so similar to foreclosure in the lending environment. Sometimes you have to sell your house for less than what it's worth and make a deal with the bank called a short sale. Sometimes you're going through a divorce and just that action may trigger these other events that we just mentioned. So divorce often means that you have to split up the property. It doesn't always happen at the best time. And so then sometimes these other credit events come right around the same time. Sometimes there's these things called judgments where you've been forced in court to pay a large sum of money. And then you go to apply for a loan down the road and it comes up and everybody wants to know what happened with that. And then just anything that caused your credit to get damaged is a major derogatory event. And so we're just going to go over some of the ways that these affect the mortgage, how long it takes to fix it, and to provide a path to the next home.
You bet. So let's dive right in. So the first one we're going to kind of expose is bankruptcy. And something that I think is important is there only one type of bankruptcy or are there multiple?
There's multiple kinds of bankruptcy, and in general, to keep it simple, a lot of people might end up in a Chapter 7 or a Chapter 13. And the easy difference that I see on the mortgage side is in Chapter 7, you've effectively just wiped out a bunch of debt, and then it doesn't have to be paid back. The bankruptcy judge has protected you from having to pay those debts back. And then from that point on, you can go about reestablishing credit, but you have a record of a bankruptcy. And sometimes there's other provisions added to these bankruptcies, so that's a super simple view. The Chapter 13 is a little different. So sometimes the judge is going to end up placing a situation where you're going to pay some of the debt back, but by getting the relief from the judge, you can pay it back at a more reasonable schedule than what the creditors were demanding. And so the bankruptcy protection ends up being a payment plan. And so in the world of mortgage finance, if you have a Chapter 7, what we're typically looking for is what date did the debts get discharged? And then the clock starts ticking on how long you have to wait to go get a mortgage.
Right. So what are some things that might help people understand which chapter they're headed for so they can appropriately plan as we get through this, what they should expect?
So it'll probably just be between the judge and the attorneys helping set. A lot of these, because it's such a common event anymore, attorneys will actually set these things up and basically present the entire plan end to end. And if the judge accepts it, it can be approved relatively quickly. So they might start it out headed towards the 13 or the 7. So most people are just dealing with the reality of the one that they're going to end up in. And so what I've seen most common as a mortgage broker is a Chapter 7, which means you had a lot of debt written off.
Yep.
And then the debt, there's a discharge date. And then all the dust settles, and then you're thinking, all right, when can I buy a house? And the good news is you can buy a house. So if you went through...
Wait, what'd you say?
You can buy a house. A little delayed applause there. But it is a discouraging moment in your life, and so nice to know you can. And then how quickly, that's the ball game, is how quick can we get back on the horse? Real important detail is it's not the same with every loan.
Go ahead.
Big picture, if you want to get right back into home ownership, you're probably going to seek a government-backed loan program. The more that the lending trends towards like private banks doing loans, the longer they're going to want to wait to give you another loan after a bankruptcy. So the typical standard is 2 years, and that comes through FHA. It has a 2-year waiting period on the bankruptcy. There are other programs out there. So if you use like the rural housing, it's a common loan program. They have a 3-year, which is interesting because they're both kind of tied to the HUD housing agency, but they have different rules. Another program that people will go seek a mortgage is the VA if you're a veteran. They'll have slightly different ways of looking at things. But as a general rule of thumb, you're looking at 2 years from the date that the debts were discharged. So what do you want to do? Well, when you find out the discharge date, I recommend you go see a mortgage broker if you're going to plan to buy a house soon. The reason is there are things that you don't want to be happening in that 2-year window. So as an example, once you have your bankruptcy discharged, it would be nice if from that point on everything was going pretty well with credit. So it's a good thing to go take a look at all that happened with the bankruptcy and see if you've got all the loose ends tied up. You know, occasionally a debt somehow didn't make it into the bankruptcy and it's just hanging around out there. And I'll have a client come in and they waited the 2 years, but there's like a debt that's just hanging out there that somehow wasn't identified or whatever. And so their credit's not that good when they get in to see us. So seeing what make sure everything has been dealt with and then start building good credit so that when you hit that 2-year anniversary, you've got the best possible credit for the next home purchase.
And I think why that matters is because you did have a traumatic event take place. And so if you think about a loan, what is a loan? A loan is someone giving you money to go buy something and with an expectation of repayment. So they want to see that this event happened, but things are looking up and your life has changed and you're handling things really well. So that's why that credit history in that 2-year period is extremely important to demonstrate change of behavior to a lender.
Yep. So once it happens, it can be as quick as 2 years if with a discharge date is clean, and then at some point in time you're going to apply for your mortgage, and it can actually be literally right on that 2-year anniversary. You can be insurable through the FHA mortgage and a few other products, and so I recommend just getting your house in order and then working with somebody who's going to help you stay on track with that. Make sure there's nothing missing. One thing I will point out is all these details have exceptions. And so sometimes the waiting periods can be shorter than what we're talking about. And they call that an extenuating circumstance. So extenuating circumstances, a quick example would be like a medical emergency. And if a medical emergency led to a bankruptcy, the lender may consider as little as 1 year of waiting to get a home. They would like to be able to verify that that is the situation. So when that is an opportunity, you want to make sure that when the lender looks at your credit and whatnot after the bankruptcy, that it doesn't contradict the fact that this was kind of a one-off medical event. And so that would be a good example.
So what happens if I do have a medical event and it was outside my control, and I'm sitting down and I'm trying to figure out what to do, and the recommendation is thrown to me that I should just go ahead and throw in a bunch of other debt with the medical debt when talking about the potential for having to file bankruptcy? Is that a good idea, bad idea? How's it impacted from mortgage world?
It could be good if you need to write off more debt and you're at that moment. But when you go to get your mortgage, if they can't isolate the event to be just the medical scenario, and then you also wrote off a boat and a flat screen TV and a few other things that maybe you couldn't afford because of the medical event.
Right.
It might not be looked at as entirely the bankruptcy was caused by the medical event. It might have been caused by also buying a few more things than you should have. So that would be a area where the lender would have to use their discretion. And so recommendation is if you are going through a one-off event and you're going to file a bankruptcy, if you can have it be the case that you can see that this one thing caused it, that would be a good way to get in concert with your lender at the front end and just see if you can get that quicker opportunity, because the lenders will allow a shorter period due to the extenuating circumstance. But generally speaking, extenuating circumstance is defined as something that happened that was somewhat outside of your control. Then you eliminated the problem, and then it's not likely to continue. So if it doesn't meet that test, then you're not going to get an exception to the waiting periods. So on bankruptcy, it's 2 years. Let's opt to another major credit event called foreclosure.
Foreclosure.
So foreclosure is you can't make the payments on the house anymore. The bank has decided to take the home.
Right.
And when you take a mortgage, you actually sign paperwork saying that if you can't pay the mortgage, the consequence will be that they will take your home, and that action is called a foreclosure.
Yeah.
So the general waiting period is going to be on the government products 3 years. And so one of the things that is good to keep in mind is they are going to look at not just the date that's on your credit report or the date that you think you lost your house. They're going to go look up in the public records when the deed was taken out of your possession, when you actually lost a house. So I've been originating loans for 16 years, and during the 2008 financial crisis, we had a lot of clients go through bankruptcy and foreclosure. It was actually a pretty common tactic in the mortgage business. Was, as a mortgage broker, to be successful, you wanted to help people get back into homeownership. So we were constantly evaluating scenarios where people had lost everything and they were trying to get back in. Yep. And so in foreclosure, sometimes there was issues with the bank agreeing to all the terms of the foreclosure with the court system and everything. And so you might have a person who thought that they lost their house 5 years ago, but the paperwork didn't wrap up until a couple of years after that due to some contested issues and things like that. So if you're going to go through a foreclosure, I would just say advice from the mortgage side is quick and clean is the way to go if it's going to happen anyway. There were people that moved to Montana from Florida, and I remember they do a different type of foreclosure there where it takes longer. And so there were people that had been out of their home for years, but the process hadn't wrapped up yet. And so once it did wrap up, that's when the 3-year count began. And so they may not have realized it. They would come in and they say, yeah, I had my house taken from me, 6 years ago. And then we do all the paperwork and look it up and everything. It looks like 2.5 years, and they're not even through the 3-year period yet. And they would be pretty discouraged because the way they felt it, they didn't live in the home anymore. And so that's a thing to think about, is it's when the paperwork at the county says that it happened, that's when it happened, not necessarily the day that you left the house.
So if I'm approaching that situation and Do I have any control over how fast it goes? Can I keep tabs on it, follow up, make sure it goes through, or is it totally outside my control?
I think the main thing for control would be to have an attorney. I mean, you don't have any money, things are not going very well, but if you can get some legal representation, it would be a good thing if you can. Otherwise, just maybe get involved. Like even if you came to me, a mortgage broker, I know how to look up and see when this thing happened. But if it's contested, and so in 2008, one of the problems was the paperwork on a lot of the mortgages was just sloppy. The banks didn't have any money to go through with these foreclosures. Everybody was struggling, so the paperwork just wasn't getting done well. And so the main thing is when you're going to lose your house, a lot of, or even if you're going to go through a bankruptcy, these are two totally different credit events. But sometimes when people go through a bankruptcy, they'll get it all done, and then they'll take all that paperwork and they'll just like huck it in a closet somewhere.
Because it feels good to do that, right?
Yeah,
Get that out of here.
Yeah, I don't want to deal with this anymore. Well, you're going to need to go get that paperwork again when you come back to the lending environment. And so same thing with the foreclosure. It's just you're losing your house. It's terrible. And you're just like, I'm out of here. And it's easy to just kind of walk away from everything. But tactically speaking, get some closure. Maybe go down to the county and just say, do I own my house or not? And they'll look it up with you. The people down at the county will show you. But know that date, because from that date, it's 3 years. But guess what, Zach? If you're a veteran, it's 2 years. If you served our country. Why is it different? It's a different loan program.
Right.
So 3 years is standard in government programs, and then there's 2, and then there's extenuating circumstances, which can be shorter.
Right.
So nice to know those details. When you're also going through foreclosure, there's a murky arena, unfortunately. So the murky arena is almost foreclosure.
Ooh.
Do you know what that is, Zach? Because you've been working in the mortgage business a bit. What's almost foreclosure?
I believe it's referred to as pre-foreclosure.
Yes. And so just so you know, foreclosure is when the moment that the bank takes the house away from you. Pre-foreclosure is you've already missed so many payments that the bank is taking the action. If that shows up on your credit report, as far as lenders are concerned down the road, you basically got a foreclosure.
Yeah.
And so the reason that is relevant is we've had a couple clients, and I think you and I worked on one together recently where the client actually sold the house to a private party.
Mm-hmm.
They were like 150 days late on their mortgage payment.
Yep.
And they actually paid it back. And so in their mind, they did not go through the process called foreclosure.
And they didn't, technically.
They did not. Legally, they did not go through a foreclosure. And our lender was fit to be tied that there was like a foreclosure, and we were arguing. And, well, come to find out that, you go past 120 days late in Montana, which is where we're recording this video, you've taken it far enough that they're going to rate it the same as if it was a foreclosure. And so then that 3-year window kicks in on the FHA and the rural development loan, 2 years on the VA. So foreclosure, major credit event, looked at differently by different loan programs. And then important detail on foreclosure and on bankruptcy is when did the dust settle on the event? So I'm going to hop back to bankruptcy for a second, but on bankruptcy, we're looking at the discharge date. And so sometimes the date from when you go to file for bankruptcy and the discharge date are not too far apart. Sometimes there's a big distance, and it probably depends on the legal proceeding, whether the judge agrees to the bankruptcy the way that it was presented or not. So sometimes people are of the impression that they went through the event and then there was a lot that followed, and the dust settled date's more the date that the lender's going to look at. So if you had a long, drawn-out bankruptcy, then the 2-year typical waiting period for like FHA is going to be after the dust settled.
Yeah.
And so in that, if you went through a long one, maybe it's 3 years for you because it didn't end, and then they start counting. Does that make sense?
It does. So kicking back to foreclosure, what if, so I'm in a tough position and I really would like to sell my house, and the economy is not in a position where I'm able to sell my home for at least enough to cover my mortgage balance. So can I submit that as an extenuating circumstance as I get ready to have to deal with foreclosure? Can I say to creditors, look, I can't sell the house, so can you cut me a break? Is that possible?
Yeah, unfortunately, no. So the lender wants to know that you're going to make that payment no matter how hard it is, as a general rule. There are some exceptions though, Zach, so I'm glad you asked. And so if you're at the front end and you haven't done the action yet, get with a lender who you might, especially if you're going to try to work with a lender later and you're going to maybe sell the house for less or something. There are some things that'll put you in a better situation. So for example, if you're being relocated for work and it's because work has ended where you are. So let's say you work for a big company and they laid everybody off, and then you couldn't find work, and the only place you could find work is in another place where you had to sell your house. That is acceptable. And so if you had to sell for less to move the family, they would rate the reason as because of your job loss that was unexpected, on something you couldn't plan for,
Outside of your control, right?
not because the market went down.
Okay.
So the market did go down and you did end up in a short sale, but the reason you short sold was because you had to sell in a down market. And so on the alternative, if you have a job and you're just hanging out and you need to sell your house, one thing they're looking for is, did you go buy a nicer house, or if you did anything like that, then you basically just took advantage of the market to sell for less. Another thing to note, just because when we went through the '08 housing crisis, people would short sale shortly thereafter. A lot of them got a 1099.
What, just in case people don't know, what is a short sale?
Yeah, so short sale is you actually contact your bank and they agree to take less than the amount owed for the house. So in 2008, this is really common.
Yeah.
In fact, you would hear even radio ads saying, if you need help short selling, give us a call, because a lot of people didn't know what to do.
Right.
So guess what, though? The banks don't like any of this. They're having to deal with it, basically. So they have different scenarios. And so one of the things is when you're going through, so your house is worth less than what you owe, and you're going to contemplate a short sale. When you contact your lender and ask, a lot of them will say, well, it seems like you're making your payments. So no, the answer is no, you can't short sell.
Right, because they don't think that you need it.
They don't, if you can make the payment, they'd like to keep resuming the agreement the way that it has been.
Absolutely.
Because eventually the market will go back up. And so it's not their favorite thing for you to sell. So what they will often say is, at this time, we won't grant you a short sale. And then you'll have people start coming around and telling you, this is what happened, at least in the '08 session, miss a payment, then they'll talk. And so that was the case, is that you would have people, they would try to get the bank to agree to a short sale. The banks would say no. And then if you missed a mortgage payment, then they would say yes. Reason being is banks like, oh, this guy is having trouble, likely to go through foreclosure. And I think in that case, we'd rather have control of the situation and go with a short sale, because at least then we know what we're going to get. This is being the bank. When the bank gets the house, sometimes they were getting quite a bit less in foreclosure. So they would recommend, or people off the record would recommend, that you miss a payment. Well, then the problem comes up down the road, Zach. So down the road, you go through these things we're talking about, and there's waiting periods for short sale, and there's waiting periods for foreclosure. And the way the banks would rate your next purchase is if you missed payments and short sold, they would treat it like a foreclosure, and they would make the waiting period 3 years. But if it was just a straight short sale
With no missed payments,
they would do as little as a year. And the problem is you couldn't get a short sale unless you missed a payment.
Irony.
Yeah. So what was good during that period was there were some realtors that were well trained in the process, and they could negotiate with a bank with you. And I'm sure attorneys as well could do this. But if you can get the bank to agree to a short sale without missing mortgage payments because the market is down, and right now we're in 2022, we don't know what's going to happen. The market's been coming down just a little. Doesn't seem like we're entering this environment yet. But if we end up in this environment where home values have declined and people's mortgages are higher in the home value, this will be a big deal again. So the tactic is work with some people who can get the bank to agree to take less without requiring that you miss a mortgage payment. That will give you the shortest window to go back into homeownership. If you have to miss a payment as a means to get the bank to agree to a short sale, you're going to be looked at more like a foreclosure. And it's going to be looked at as a more derogatory credit event.
That's good to know. What if I'm a veteran? Does this stuff still apply?
It does. So the veterans, in fact, I've got my little list here. The short sale is much more lenient for the veteran.
Right.
The main thing for the veteran to know is you use what's called an entitlement to get a mortgage through the VA system. And that entitlement has a lot to do with the down payment required. So a lot of veterans are going to fall into different categories.
Sure.
But the best thing about the VA loan, just in general across the board, is if you served our country and were willing to do what you had to do to serve our country, your VA loan benefit, as a general rule, is more forgiving than all the other loans out there. And they've actually done the data, and just veterans are more likely to pay a loan back, just statistically, than the average citizen. And so they give them a little bit more cover on major credit events. They do need to document things, and there needs to be an analysis done. But with the VA, I'd say it's not that simple as just like a particular number of years.
Right.
So if you have access to the VA loan and you're going to go through credit trauma, you're in the best place. That's the best loan to help you out of that situation.
Absolutely. Anything else on short sale, foreclosure, pre-foreclosure, bankruptcy?
Well, there's a whole bunch of things that are good to know just in the mortgage space. So let's talk judgments for a second.
That's where I was going.
The different scenarios exist, but as a general rule, like take your veteran, for example, a little cool thing that a lot of people don't know is a seller can pay a judgment off for you in the purchase price of a home. So we're currently in a market where there's a lot of realtors going around asking to get interest rate buy downs and various incentives. If you're working with a veteran borrower, you can actually get the seller to agree to pay down some of their collections and whatnot to qualify. And the amounts are surprisingly large of what the seller can do. And so they can actually help put a veteran into home ownership by taking care of something that happened in their past. And then other loan programs generally take the position that if you have a judgment, the simplest answer is you have to pay it before you go buy another house. Or if you have a major credit write-off that is still showing a balance due, you got to pay it. There's some exceptions, though.
I'm sensing a theme here.
Yeah. So there's always exceptions.
Right.
This is where the fun part is if you're a mortgage broker. The exception is if you enter a successful payment plan on major credit items, kind of like the Chapter 13 bankruptcy.
Right.
So there are some common themes in lending, and I guess that would be an example of one is you have a major credit write-off, so to speak, and the judge has ruled you owe a large sum of money, but you can't pay. And so the workaround is they allow you to make payments.
Mm-hmm.
So a lot of mortgage lenders, if you've been in that situation for a year, let's say you owe $100,000 on a major judgment or failed situation that the judge has ruled you have to pay it back. If you have a $500 a month payment and the court is okay with $500 a month, and you can actually it looks like a car payment on your mortgage application. And if you've been making that payment successfully, then you don't have to pay the judgment. You just have to show that you've entered an agreement and everybody's satisfied with the agreement.
So what if I don't agree with the judge's decision and the judgment was handed to me unfairly, in my opinion? Does that give me the right to not make the payments? Do I get to call that an extenuating circumstance when it's time for a mortgage? How do lenders handle that?
Yeah, so that's a big no.
Okay.
But we hear that a lot. So my advice is when you're going through credit trauma, get to a point where you're going to accept the outcome,
Right.
wherever that is for you. But when you come back for your next loan, the one thing a new lender who doesn't know you yet, it's a brand new lender, if you come to see me for a mortgage and you want me to loan you $400,000 to buy a house, and you're going to tell me that the last creditor that loaned you a bunch of money was a jerk, and I don't agree with the way they handled their payment process, so I decided I wasn't going to pay that loan back. My interest in you just went down really fast. Now, it might have been valid. Like, you might have had a really good beef with that creditor. But when you go back to the well of credit, you need to have made your peace with it, and have some kind of agreement that you can live with so that you can get back into credit again. And it's tough because there are people who have been harmed by creditors.
Yeah.
And so the best way to look at it is if you never want to get credit again, you can take the tough position that some creditor ripped you off and you're not going to pay them back and the judge didn't even agree with you. As long as you don't need credit again, you might be able to pull that off here in the USA, because maybe it's just going to hang out there and you can not make payments on it. But once you'll notice that anytime you go back to the well of homeownership, they're going to pull a title commitment, and the title company is going to search the court records, and they're going to bring this up, and you're going to have to, have your moment where you deal with it. So if homeownership is something in your future, best thing to do is actually just get into a payment plan. At least you don't have to pay it all off right away.
Yeah.
You can make payments. And then if you get a house and you want to play the game, then that you have a house, and then you can go maybe rework it with the judge or something like that. So.
And this is true before you even get to the judgment phase too. It's just good credit management. We hear it a lot as well on the medical side.
Yes.
Where you've got maybe somebody who claims that the hospital didn't send them the bill, or that the hospital overcharged them so they didn't want to pay it. And, that doesn't necessarily create a judgment right away, but it does create a negative credit event. And unfortunately, the excuses just don't work. So an advice item to those of you watching this is be really proactive with bills like that might be confusing, or maybe you don't know for sure if you need to pay it. Like, call the hospital. Do I need to pay this bill? Because the whole point of this is how to plan and make sure that you're in a position to be a homeowner, and that's just another step to keep on your agenda.
And then I'm just going to mess with Zach here, but the everything you said was correct about making sure that you get with any creditor, including a hospital, and work it out with them, is what I heard you say.
Correct.
However, in the world of mortgage lending, the most grace will be extended on the medical. So if you can limit your exposure to bad debt to medical, you're going to be in a way better situation than all the other forms of credit. So if something has to go bad, like let's say you have tough time and there's at the kitchen table, there's a stack of medical bills and a car payment and a mortgage, pay the mortgage and the car payment. And if you run out of money and you don't get the medical, they will actually waive almost the entire waiting periods if the only thing left on the table that didn't get paid was the medical.
Exactly.
So the lending industry is compassionate toward medical, and the reason is what we talked about earlier, extenuating circumstances. The way that we understand it is the average person has a family budget, and they can control their monthly payment on their car. They can control their housing payment somewhat. They cannot control if a $150,000 medical bill just comes and hits them out of nowhere. So if you can isolate that damage to where that's the only thing that isn't getting dealt with, the lenders are actually going to be very workable to give you a future mortgage, and just to let that sit there until you figure out what you're going to do with it. And that's actually one of the bankruptcies that's easily shortened on the waiting period. Basically, if you have a medical bankruptcy, you file it, you can almost go right back into homeownership if you can prove it to be just a medical event.
So I like what you said. Mortgage, car payment, medical bills. For our audience, where do credit cards fit in there in the priority? Mortgage, car payment,
They're
credit
right
card,
in between.
medical?
They're right in between medical and the car payment.
Okay.
So
All right.
unsecured revolving debt, which is credit card, some of these personal loans that you get offered that there's no collateral attached
Like
to the
debt
loan.
consolidation.
Debt
or something like
consolidation
that.
loans, those kind of things. So those are not as important as your car loan.
Okay.
And then your home loan is the holy grail. So if you have to rank credit, you always pay the housing payment, and then any debt that has an asset attached to it, like a car or an RV, just anything where they could go repossess it, that is right behind the house, because the action of repossession of a car that's basically right close to the foreclosure.
Yeah.
It's not quite as bad, but it's not good. And so, if you're ranking, you want to rank them that way for sure.
So then why is the mortgage payment the holy grail? Do late payments matter on a mortgage more than they do on, let's say, a car payment or a credit card payment?
Yes. And basically, I guess we're biased because we're talking about getting a mortgage loan. So we deal in the space of getting you your next mortgage loan.
Right.
And so there's some grace extended on mortgage payments, but as a general rule, 30 days late here and there is not considered something that you can't get over very easily. A couple times running to the 30-day late mark is going to keep you eligible for homeownership. A lot of the loans, when you hit 60-day, you've now crossed a threshold and you're starting to look dangerous.
So you mentioned a couple of lates here and there. Can I have back-to-back 30-day lates
in
a 12-month period?
You can have on certain, there's different scenarios. So we're not going to cover everything on this video today, but I'll just point out real quick. We're going to put links on our webpage, and we would just love to take these calls so that you don't have to go digging through the guidelines. But I'm going to actually put the guidelines right on there. But there are direct guidelines that you can look up for Fannie Mae, Freddie Mac, FHA, VA, and U.S. Rural Development. These are the major programs that you can basically get a loan after a major credit event within a certain period of time, which is some of the time periods that we talked about. So you go there, and then they're going to say specifically. But as a general rule, like in a 12-month period of time, if you had 2 30-day lates, you could still potentially get a home loan. If a 60-day late, you're starting to get no for an answer. And then if you go beyond that, now you're looking like a credit risk. And what the lender wants after these lates occur is a cooling off period. And so if you do end up late, and you avoid anything traumatic like pre-foreclosure or anything like that, you just have some lates, the remedy is just going to be getting into a 12-month clean housing history.
Right.
That's what the lenders are looking for. Because you could probably explain, using that model that we talked about a little bit ago, something happened, it was outside of my control, I fixed the problem, not likely to continue. If you can explain that to some late payments and then you resume normal payments, that's going to put you back in good standing with lenders.
So just for further illustration, can I miss car payments at the same sense of importance? Or can I miss more car payments than I can mortgage payments? I mean, the answer is obviously we never want to consider that, right? But let's say I had to make the choice.
Well, I would say housing payment is the king, so you always make your housing payment. And then if you're short cash and you're gonna have to fall behind on something, the first thing you pick is your credit cards. If you have to move over to the car payment, and then what do you want to catch up first? Well, if it's a house first, car payment, move on to credit. What happens for most loans, just to kind of keep it simple, is your entire credit report, which bundles all this together, that score is based on all that. And as you
Right.
start layering on these scenarios, your score is going to drop pretty hard and you're going to go below their minimum
Right.
until that cooling off period comes along. So, but you're bringing up a great point that's going to go back to the beginning of the class, which was bankruptcy and foreclosure. When these things happen, it's imperative that you take a look at your credit report quickly after the event and see that the lates have stopped. So that's what's supposed to happen in a bankruptcy is you go through bankruptcy, the judge gives you a clean slate, and now the waiting period is just to make sure that you can clean up, get your act together, and get going again. But if there's anything hanging out there and it's still rolling late, that is your credit score. It's not going to get better until you fix the problem. So getting back at that individual items of credit and just why we're even offering education on this is if you want to plan to get a home quickly after your major credit event, you want to make sure that the bleeding has stopped.
Right.
And you've applied the bandage and now you're healing. And so healing is no more lates. So if the mortgage is still rolling lates, it means that paperwork hasn't processed yet. You've been kicked out of the house for some reason. The mortgage company still wants a payment every month and they're reporting the fact that you're not making the payment. So you need to make that stop. And sometimes you need legal counsel or something to get to the bottom of it. There were people in the 2008 housing crisis. Unfortunately, not all the banks performed their duties right. And so you would need potentially legal representation to get the bank to properly process the foreclosure. So the main thing is just get involved with experts, people who know what they're doing, and look forward to your next home. I think if I could just point out anything is things happen. When I was originating mortgages in 2008, prior to that major economic challenge that we all faced, I had a pretty high view of everybody ought to just pay their bills. Like I wasn't very compassionate about people who didn't pay their bills until I saw real economic devastation on a level that I had never seen before. And then I see families coming in like, I based my ability to pay all these bills on this job that I don't have and on this. And you could see the scenario was impossible for these people. And they were going to have to bite the bullet and they were going to have to go through these major credit scenarios. And so after having lived through that, I'm like, okay, well then this should not be a permanent condemnation of this person. We need to help them buy a house. And it was a great time to help people like, okay, here we are. It's 2008. And in 2010, we're going to start shopping for a house. And so start building the roadmap. And the roadmap can be built and it goes much better with planning and preparation. So big picture items was there's the 2-year wait on a lot of the government products on bankruptcies. There's a 3-year wait on a lot of the foreclosure type stuff. There's a couple others real quick. I'll just hit real quick, but credit counseling. So a lot of people will bundle up all their credit in a credit plan. A lot of those, when you go back for your next mortgage, there's like a 1-year cooling off period and then you can resume. So an attorney might help somebody not go through bankruptcy, but just get the creditors to agree to a bundle up and they just make a monthly payment from here on out. Well, you weren't able to pay back as agreed. You had to pay back under some form of compromise.
I see.
And so credit counseling, if it shows up on your credit report as such, at a minimum, under all the government products, you're going to have to show that you're able to handle the new situation and things have been restored to order. And then a lot of them, it's 1 year plus making the payments on time, and then you're good. Similar to what we talked about if you have a judgment and you don't want to pay the whole bill right now, they use a similar model and also similar to that Chapter 13 bankruptcy. So when you're paying your way out, a lot of times they just want to see that you've done it for about a year and now you're back into home ownership again.
That's great. I appreciate you highlighting the opportunity for compassion because that's ultimately what our efforts should be focused on. So, Dave, do you have any concluding thoughts today for our audience?
Big picture, well, a couple more fun details and then we'll wrap it up. But
more info.
When you're looking at the different loan programs, understand that they are genuinely different.
Yeah.
So the rural development loan looks at a couple things completely differently than FHA, and they're both backed by HUD. So it's kind of interesting. So just rather than assume if you've heard one guideline that that's the end of the road, make sure that you can check out all the different loan programs. Because after you go through a credit event, one of these loans is going to be the one that's going to be better for you.
Okay.
And so and so I'm going to give you a quick example to kind of wrap things up. But in all the loans except for the VA, let me check if this is the VA or the RD. I actually have to check my guide here. Okay, yeah. If you read the VA manual, it says, do not ask the veteran for a copy of the divorce decree unless you have to have it. This is an instruction to the underwriter. On all the other loans, it says, go get a copy of the divorce decree, read it, and the property settlement agreement. So the VA is looking after veterans who go through a divorce, and they're saying, hey, if you're a lender out there and you're going to participate in the VA loan program, mind your own business on some of this stuff. And so it's like, because when I first started originating loans, I did a little bit of VA, but a lot of everything else. So it would have never occurred to me that the VA wrote into their manual, don't ask for the divorce decree unless you have to see it. Now, you might need to see it because there could be like a distribution of property in there. But the point is, there could be something in a divorce that leads to some credit trauma. And the way that the VA refers to how to deal with a divorce might position a veteran in a much stronger position than all the other loan products. And so just those are a little detail. You're never going to know that unless you're like reading loan guidelines for a living.
Yeah.
So they all have different guidelines. And so the proactive measure is if you're going to go through a major credit event, well, then, like, for example, I'm going to lose my house in foreclosure. Like I'm 150 days late. I've talked to my wife and I'm like, you know what, we're going to lose the house. Okay. This is a terrible day. I could just bury my head in the sand and kind of just move into a rental and in a couple of years dig my head out and go, now what? Or I could get ready and as we're moving out, make an appointment with a mortgage lender. Just go down and say, hey, you know what? I'm going to lose my house in foreclosure. How quick can I buy a house after this? I'd like to get my loan from you. If you tell me that, I'll be like, oh, I'll work for you.
Right.
I mean, as long as I know someday we're going to do business together. And then I can give you the roadmap and you can start planning. And so then, like I was telling you, in some of these details that are different, I might be able to give you a better situation than what you expected.
Yes.
And so same with a bankruptcy, devastating situation. It's embarrassing. You probably don't want to go talk to anybody.
Yeah.
But you are in the future going to want to go talk to somebody. You know what they're going to do? They're going to make you talk about all this anyway.
Yeah.
So you're already in the middle of it. Just go talk to a mortgage lender and go, hey, as soon as possible, I want to buy a house for my family. I'm going through bankruptcy now. What is the deal? And then you can get the roadmap and it can go dramatically faster. The most unfortunate thing I see in lending is people make assumptions about how it works. And then we get down the road and then there's something with a time frame attached to it that wasn't known. And the clock starts ticking when they find out about it. And all that time in between was wasted.
Yeah.
And that's just not necessary. And so purpose for the class, check out our webpage, fire us any questions you have. If you're a professional, probably there's little details that could affect your client that could help them. And so if you ever have a scenario and you just want to have us take a look at it, I'll send you the exact guideline.
Mm-hmm.
I don't want anybody to take my word for anything. And as a even further point, every time the United States goes through a major situation, they change the rules a little bit.
And just so people understand, these guidelines are prescribed to people that have insomnia. So the point is you don't want to be the one who goes through them. You want to trust a mortgage lender to give you that information.
I mean, to be blunt, somebody who's got an incentive to help you buy a house.
Yeah, utilize that.
So just to give you a quick example of how things change, I spent all my time in mortgage, so this is my 16th year, thinking that forbearance was a pretty bad credit action. But when COVID came around, it just became like no big deal. So weirdly, I don't know what they're going to do the next time, but when we had COVID as a country, you were allowed to enter forbearance and get out of it with almost, I mean, there were still consequences, but they were extremely small compared to whatever was going on prior. And that could be just COVID. It may not be the case that in the future, but the rules get laid out. And so if I was telling all of our clients during forbearance, I said, before you hit the button and enter forbearance, can you just check in with us? Let's talk about why you're going to, the smarter clients are the ones that were in a better position, were the ones that didn't just go hit the forbearance button. Yep. What happened to a lot of them was the lender's like, yeah, we'll give you a loan if you were in forbearance and we won't count it as a negative thing, but we're going to make you wait 3 months just because we need to make sure that you can make your mortgage payment. Well, why was that significant? Well, what was going on right after COVID was we had the lowest interest rates in the history of our country. Mm-hmm. And everybody's like, I'd like to refinance now. And they call and like, well, your loan's currently in forbearance. Like, you don't even make mortgage payments right now. And it was okay, but you had to wait 3 months. Well, that's significant because if you want to lock your good interest rate, you might need to lock it long enough to wait for 3 mortgage payments, which would make it a little more challenging. So well-off people might have been better off not entering forbearance in the first place, you know. So these are little details. Like, we want that call before the credit action. We just want to help you out. So any lender would be happy to do that.
Dave, appreciate it. This is good stuff. I hope you guys in the audience enjoyed what we presented today. We hope ultimately that you never end up in these positions, but we understand that life is life. And so I think it's safe to say, and what Dave is really saying is and there are people in the world that want to help you. And so look for those people, put them in your circle, and figure out how to get the help when you need it. Is that a fair thing to say?
Yeah. I mean, if the bottom falls out on you credit-wise, if you play your cards right, 1 to 3 years and you're back into home ownership if you do the due diligence of just checking it out ahead of time. So if you look at the severity of the event that you're experiencing, it's a reasonable, it's not that long until you're back on the horse again. So plan to get back on the horse again so that it doesn't take an extra couple of years. So just get the playbook at the time of the event, and it'll go a lot better for you.
Thanks, Dave. Appreciate it. Thank you guys for watching.